I was a budding gymnast when I was a young man.
Oh, gosh.
I'm not lying. I had hopes of achieving Olympic gold for like a week.
I mean, you've obviously missed your calling.
Well, there's not too many 6'5", 300-pound gymnasts in the Olympics, so I think my dreams might be shot. But
it's never too late, Carl. It's never too late.
That's it. You'll have
as
to
long as you want it.
Yep.
All right. Well, gymnast Carl is a future gymnast aside. I want to thank everybody for joining us today. This is one of our editions of our CWDL webinars. Just a few housekeeping items. If anybody has any questions, everybody is automatically muted, but you can feel free to raise your hand or you can type it in the chat box. We really like these to be as interactive as possible, so please feel free to join in. That's what we're here for. So I will start off by introducing Susan. She is the director of our accounting and consulting department. Susan's been an amazing addition to the team, and she's built a remarkable team. We've been able to really help out our clients and provide some transformational information, processes, practices, and so we thought we'd share some of her expertise with you today. She was a controller at a mortgage bank in the past, and she had her own consulting firm, and we have managed to rope her in at CWDL, and we're super happy to have her. So that's Susan. We have Dustin Pfluger on. He is our mortgage banking partner. Dustin helps out and heads up the audit department. He doesn't like me to say how much experience he has because he feels like it dates him, but
yeah.
But Dustin is highly experienced and really adds a lot of help for hedging and KPIs and things like that. So we wanted to include him on this call. And we also have on Carl Wooloff. He obviously needs no introduction at all. Very small personality, high hopes of being a gymnast, and instead is now the director of sales and marketing for Loan Vision. We are pleased to have him on and appreciate you being a guest in our webinar series. So with that being said, let's kick it off. I think that we hear from our clients all the time the term loan level accounting, and we really wanted to dive in and discuss what that actually means. So Susan, if you want to start off just by kind of, explaining what is loan level accounting.
Pretty simply stated, it's just the ability to get your transactions on a loan level, right? So you're able to drill down on loan level and find out what actually makes that loan up. What profit came out of it, what expense was incurred during it, what commission did you pay out on it. So it's basically just any of the expenses that are on that particular loan and what explains what happens during that loan.
Well, and I think it sounds so simple, and yet when we dive in with our clients, so often they're not seeing that, Joey loan officer is the one that's asking for all of these concessions, and even though he's doing twice the production of Casey loan officer, that net profit is really being impacted, and I think we can all attest to the fact that this industry is super fast paced. I mean, who knew 2020 was coming? I obviously didn't. And we're trying to just keep up, keep our salespeople happy, keep our operations moving, and fund loans. And I think so often, we aren't looking at the real important data that's being driven out of loan level accounting. So I think I just answered the question I was going to ask you as to why it was important.
Well, I think let me chime in there as well. I think there's now, granted, I look at the attendee list and there's a lot of the people on this call that are probably here for some of the later stuff, because they are already doing loan level accounting, or they're using a loan level accounting system. But there's also some folks on the call that, that maybe aren't and are using generic tools. And one of the things, I think there's a bit of a misunderstanding around loan level accounting, because I think people just think, well, it means loan level profitability, and it doesn't. Right. As Susan has eloquently explained to me before, when you move to loan level accounting, you're moving from, typically like a cash-based kind of accounting process to a GAAP-based accrual process, and that completely changes the way that you account. It gives you a lot more information, and you can now look at leakage and all these other things, and we'll come into that in a minute. But it's a whole ethos change. So for me, it's not just as simple as looking at, the end, in the simple terms, it's looking at a transaction at the loan level, but it's really a complete change in the way that you account within the organization, with the end of some stuff we'll talk about in a minute when we get to the when is it necessary part. But there's a misunderstanding, and I think a lot of people, when they learn or look to make a transition from a non-mortgage accounting system to a mortgage accounting system, whichever one you go with, and there's some great ones out there, as we know, they misunderstand that, right? They think it's just I just need to track things at the loan level, but there's so much more to it, and I think people need to be aware of that as they and we'll get to some of that stuff as we go through this process here later on today. But that's my 2 cents.
I like it. And I think that's a good segue into, when should you really start looking at a system that can support loan level accounting, and when is sort of QuickBooks not going to be sufficient to support your current business needs?
Right.
Yeah. Susan, do you want to go first?
Sure. So, when does that process break in QuickBooks? So you think about all the manual entries you have to do in QuickBooks in order to do it on the loan level and try to do it as much as loan level as you possibly can. We find it's not necessarily a number of units, but if we had to guess with the number of units, when you get to over 200 units, you can't do it. Everyone has all these spreadsheets and tries to do it loan level within QuickBooks. You can't do it. It's with pivot tables and trying to stay compliant with your escrows and your MIP accounts. That's super difficult in QuickBooks. So that's kind of when it breaks. When you kind of get to that level, there's at that point you can't do loan level. Everyone tries to do a loan level in QuickBooks, but it just doesn't work at that point. Just too much activity and too much transactional data that's being keyed into a system that just doesn't work.
And go ahead, Carl. Go ahead.
Yeah, no, just to add to that, I would agree. Obviously, we're not the CPAs, right? We're not the professionals. So ours is more of just what we see in the industry. And obviously today, that's where a lot of my kind of comments are going to come from, purely observation, right? I'm not qualified to talk about when or how you should do this stuff per se, but I can tell you what I see. So we often see people coming to us around 100 loans a month. That's really where they start to struggle. Now, to kind of counteract your point, Susan, we've seen some very successful organizations go up to 500 or 600 loans a month on a non-industry tool, right? Because there's several. It's not just QuickBooks. There's a number out there, all great platforms, but again, don't have necessarily the tools you're looking for.
Right.
But we have seen some companies go a lot higher because they have great people, they have great support networks, they have supporting systems. So you can go higher, but it's a rarity. It's the exception to the norm. So we often see people coming to us, 100, 150 loans a month. They're starting to really, having to grow that accounting team, right? They've gone from one person, now they're trying to do loan level in QuickBooks, and they've now got 3 or 4, and those people having to work, a lot of extra hours, or they're paying a lot of overtime and things like that. And that's when they start to think, oh, maybe I've got a problem, right? So that's when it becomes necessary. But it's also, as they look to become more complex organizations, as as well. So as we move into hedging, and they start to sell into the GSEs, and they have to have the financials and the things that come with a solution that allows you to do that, or a process as much as that gives them that information they need for a warehouse line covenant or their MBFRF reports and things like that. So it's not just about, for me, the number of loans. The number of loans is just an indicator of, right, we're now a bigger organization and we're going to be more complex. Does that make sense to you guys?
Yeah, and not only that, I'll add in a little bit here, because y'all talking about internally stuff. Externally speaking, from an audit or a tax reporting perspective or stuff like that. There's just not non-loan level. There's just stuff you can't do. There's stuff, from an audit perspective, we can't get the right support, or from a tax, they can't get, state reporting right and stuff like that, or Carl mentioned MBFRF, or any kind of KPI softwares or anything like that. You have to be there. when you move to that kind of stuff. So I mean, again, it may not be numbers. You may be a very sophisticated mortgage bank that's already doing KPIs at 100 units a month, and you're going to need something better.
And sorry to chime in once again, Casey, but just on the why is it important piece, right? Looking at this from, again, I'm not an accountant, so I look at it slightly differently to you guys, right? You guys are all about compliance and making sure that the numbers tick and tie. My job, really, what we do and what other softwares do is really essentially to maximize profit, right? Because that's what we're all in business for. I'm not being funny, but I don't wake up in the morning and go, I'm going to go sell mortgage accounting software. I love what I do. I'm very fortunate, but it's not what drives me. I'm here to provide for my family. And that's what all these business owners are trying to do, right? And so subsequently to do that, they need to make money. And a big piece of loan level accounting is giving them that profitability or that increased capability to make more money, right? And probably at a loan level, managing leakage better. So, are we actually looking at actual versus anticipated gains? Are we looking at, like you said, concessions per loan officer, things like that? So that's why it's important. All the other pieces are subsidiary to that. They play a part in that, but ultimately, we're here, these companies are for-profit organizations and they want to make the most money. And if they're not compliant, they're going to get fined. So they're going to lose money. If they're not looking at loan level and maximizing profit that way, they're going to lose money. So for me, the big why behind all of this is ultimately to make more money as a company, but make sure we do it legally and fairly and all that kind of stuff with it. Does that?
And just to make educated decisions, because sometimes it may not be, maybe they're going to have to spend more money on something.
Yeah.
They at least know, like, hey, we're going to be ramping up here. We know our pipelines at this. We need people, and so we may be losing some money in a couple, but so it's just educated decisions.
Yeah,
overall.
maybe that's a more polite way of putting it, Dustin.
Well, I think that clean financials and understanding, I think oftentimes your accounting department is sort of overlooked. It's something that as long as, companies are in the green and things are semi-working, companies aren't necessarily really focused on making sure they're driving the cleanest data out of their LOS into their accounting systems. The foresight and information that you can pull from your accounting department can really help you make critical business decisions for the future that you may not see otherwise. And I think that's also a good opportunity for us to segue into. Susan's made a great list on the 10 best practices to improve your monthly financials. I think it's probably one of the most popular questions that we get is, I'm not getting my monthly financials out. When should I get my monthly financials out? Why am I not getting my monthly financials out? Why do your monthly financials look totally different than my monthly financials? So let's go ahead and share the screen on Susan's 10 best practices to improve your monthly financials. We'll wait for that to pop up here for a quick sec. I hope. Because I specifically did not want to have control of the shared screen because I was sure I wasn't going to do it right. So
there we go.
Good job. There we go.
Right.
Yay. All right, Susan, if you could go ahead and kind of talk us through this.
Absolutely. I mean, we're not going to dig in really deep, but these are the top 10 that we hear all the time and what we're kind of come up with at CWDL and how to improve it. I mean, we hear this all the time. I can't get my financials out on time. What can we do throughout the month to help get those financials out? So the top one is just to increase mid-month activity. I mean, it's pretty straightforward. Get your loan sale for sale balance on a consistent basis. All your warehouse activity, escrow should be trued up on a daily basis. Get your cash reconciled daily. So, if these are being done on a consistent basis, your month end is done, right? You're only really looking at one day, 1 week, or whatever the case may be. Understanding the activity, that's super, super important. Some of it is transactional. It's like your payroll journal entries. Other are rule-based. Maybe it's your escrows and your MIP true-ups and things like that. So really understand the different types of transactions you have will help you drive it to your financials come out in a little bit faster and then being able to come up with a sort of a timeline. Standardizing your documents. That's pretty straightforward. How's my payroll journal entry look like? How am I getting that into my accounting system? Your LOS, what reports are coming out of there? Standardizing them so they're all uniform, so everyone has the same information coming out of the LOS. And this is a big one. We hear this all the time. Like, how do we build bridges outside of the accounting department? And it's not just within your own organization. We hear all the time, our vendor doesn't give us our invoices until the 7th of the month. There's no way we can close. Well, build a relationship with that vendor. Tell them that you need it earlier. See if you can reach out to them. Can you email it to me instead of waiting it to come in the mail or so on and so forth? There is a login that we can have that we can possibly get that transactional data.
Susan, we hear all the time that we can't get it in the format that we maybe we want to import it into our system.
Yep.
It's in a PDF, but we need it in CSV. We have to hand key it. And I often say, well, have you asked them? Have you actually called them up and said, can I have that in an Excel format? Oh, no, we didn't think about that. And so just like you said, to your point, build that relationship, ask the question.
Yeah, ask the question. And it's the same thing with your own department. We hear all the time is, closing hasn't finished putting the PAs into the LOS system, therefore we can't finish the closing. Well, build a relationship with them. Find them, how long does it take them to do it? Is there anything the accounting department can help and assist with that? So that's what we're talking about, building the bridges to all external departments outside of the accounting department. Cross-training, we all know that is key to any successful business. I'm sure you all say, hey, listen, try not to take any days off during closings, but things happen, right? So if you cross-train, you're always able to sort of keep that structure in place during the month-end close. And this is the most important, and Carl's totally going to chime in on this, but embrace the automation. What we find all the time is that people have a great system, but they don't automate everything. Automate. If there's anything you can do to improve your close, is to get the automation to work. Yeah. So, right, Carl?
Yeah, I would. Yeah, I mean, obviously, 100% agree. That's a big part of what we do, and I would also add to that, to your point about building a relationship with the vendors and around invoices. Build a relationship with your software vendor. Okay, we have some fantastic customers, and some we never hear from, and it kind of drives us nuts, because it's like, well, they'll reach out and go, well, we're struggling with this, or we're here through the grapevine, this person's struggling with this. And if they just reach out and said, hey, this is what we're struggling with, is there anything in the system, or what are others doing to get over this? We can help them leverage that, because there's some folks that have got our tool but don't necessarily know everything it does, or there's others that have got other accounting tools, and they'll come to me and say, well, we're thinking about changing. And so, well, you're not even using the tool you've got properly. So you explored that properly, and so exploring everything it can do to help you is huge. Absolutely, I couldn't agree more with number 6.
Yeah, absolutely. And then improve processes. I mean, this is an ongoing issue. It's continuous. It's, as you grow and as your accounting department grows and as the company grows, those processes are going to break. I mean, it is what happens. So you're constantly going to try to improve those, and then you're not going to make dramatic improvements overnight. You kind of have to sort of identify what the issues, what's the holdup, what's the bottleneck in a closing, and then sort of work towards to try to improve that. And like I said, that process is always going to happen. It's going to break at certain points, and then you just got to rebuild that process. The key thing that we recommend all the time is a detailed closing schedule. If you don't know when things are supposed to close, if someone who's closing your bank reconciliations don't know you want it done by the 3rd, and that it's an all trickle down effect. If they don't have a great structure of when that closes or what the due date is, then you're just never going to meet your deadline. We always say, work backwards. When do you want to officially have your financial stream management team? Then work backwards from there and try to make sure those timelines get done. Things can get done simultaneously, other things can't, right? So having a really detailed closing schedule will help. And then set realistic expectations. Right now, if you're closing on the 20th, please don't expect to all of a sudden close on the 5th. Baby step it. You don't want your team to become overwhelmed. And what works for one company may not work for you. Maybe you're hearing they can close within 5 days. We're taking 20 days. Well, you're not going to go from 5 to 20 overnight or 1 month. Make it a game. Say, all right, it's the 20th. You know what, team? We're going to try to go for the 15th of this month and see how fast we can get that closing happening.
I think it's about understanding the organization you are as well, Susan. You know, if you're a retail lender, you've got a lot more trailing things that happen after month-end close, especially around AP invoices and things. So it's going to be a lot harder to close. Not saying it can't be done, because we've got some folks that do in 3 or 4 days. But you've got to be realistic as well. Whereas if you maybe you're more of a wholesale focused, it's a little easier because you don't have some of those things. So it's about making sure you understand what type of organization you are as well.
Right.
And like you said, setting realistic expectation. And
realistic, you have to. I mean, you don't want your team to become overwhelmed, and you don't want to become overwhelmed, or anyone who's in charge of it, because if it just doesn't work. So you're right. Know what you can expect and what your expectations are. Yeah. And then the final thing is, talk to your team, make it a team effort. Empower your employees to make the decisions. How are they going to get it done? Maybe they have a different realization of how fast they can get things closed. So, I mean, it's definitely just a whole group effort at that point in time.
The one thing the only thing I'll chime in here again is, I mean, I haven't been in Susan's seat or a lot of people on this call seat. I've always been on the external side, but I mean, knowing your external deadlines too. I mean, I think everybody has has a monthly or quarterly reporting with their, warehouse banks. You have MBFRF reporting, then year end, and just knowing those and kind of back out. I mean, an audit takes 3 weeks at year end, and maybe longer if you get delayed or you get into it, and just know that hey, we need clean, data to get there. And so yeah, just one minor thing. And
the other thing, that's a great point. And the other thing I also want to bring up, if you're doing this stuff on a daily basis and you're constantly reconciling your your balance sheet, you're audit ready like every single month, right? So when it becomes audit season, because we're all going through it right now, it's a breeze, because you've already been taking the time on a monthly basis to really reconcile those counts and clean them up. So during audit time is, like I said, right now, it shouldn't, if you're doing it on a monthly basis, and audit doesn't mean anything to you.
Yeah. Susan, I was gonna say exactly the same thing. The people that we see having the most success around speed of close and things, regardless of system, again, right? This has nothing to do with what system they run. It's people that are organized and structured and really have a handle of what happens on a daily basis and a weekly basis. And we've we got some great customers, but they will do things on a weekly basis, and it's or a monthly. So you considered moving that to a more frequent process, because it's a lot easier to eat a slice of a cake rather than the whole cake in one go. And simple mindset changes like that definitely can have a big effect on that speed of getting things closed. Again, that's not systematic, that's process and being honest with yourself.
Yeah, I mean, to just add a little, I mean, I think it is a good example here, Carl. There's a person on this call that, was on QuickBooks for the longest time, and they were a $1 billion lender and had 3 people in their accounting department using QuickBooks. And I mean, they were an old client of mine, and they would be audit ready January 15th, and we'd have the audit done by the end of January. I mean, because they had everything in place. They are now on Loan Vision, but they had everything in place. They were ready to go, and they had the processes, and they knew, and they were done, closed, and ready for us to go.
I don't know. I mentioned earlier, there's companies out there that definitely go beyond 200 loans a month. Those are those types of companies, Dustin. Absolutely, the ones that are on QuickBooks or Mass or whatever until 600-700 loans a month. But because they have all the process around it and they truly understand what they got to do, they can grow to that size on that type of tool. So no, I agree with you, and I see a few names on there that, and I don't know who specifically you're talking about, but I know there's a couple of the people that call that were very similar to that, because they're just very well run departments.
Yep.
Well, and I think that that speaks to kind of being proactive as opposed to being reactive. And really taking the time up front to make sure that your processes are in place. That also takes us on to the next topic of the importance of operations really supporting your accounting department. And when you have those processes in place, be it on QuickBooks or Loan Vision or AMB, you really have the opportunity to maximize the information that you're pulling through. And I think we hear it so often, that it's going to be such a massive undertaking to make any changes, because operations is just trying to get things done to make the sales team happy. So it's a huge bridge. And, those 10 best practices you just shared, Susan, seem so, simplified But at the end of the day, we really see, and it's usually in a very reactive manner of, oh my goodness, we didn't have the right processes in place. We don't have the right people in place. We don't have, that combination. So let's talk a little bit about data hygiene. It's a hot topic at the firm right now, and really making sure that the information that you're getting into your LOS is correct and done with care and intention.
Let me start with a use case, right? Because you can have the best softwares in the world, and you can spend thousands and hundreds of thousands of dollars on technology, but if the data going in is garbage or not sufficient, that technology is utterly wasted, right? Whether it's our system, whether it's my good friends at A&B, whether it's NetSuite or one of these more expensive tools, right? They are only as good as the data that's being put in it and the people that are using it, okay? And we have seen, again, in engagement cycles where people are like, well, I'm using this and it's not working like I expected. And you start to pull back the layer of the onion, and you find out that actually it's not a system problem at all. It's the fact that the commission's data isn't there that they need, right? That's not the system's fault. That's the operational side of things. And I know you guys are going to go into how you work with those guys, but quick anecdotal story. Very early customer of ours, doing about 1,000 loans a month or so when they moved to our system. The C controller was pulling his hair out because he couldn't get the business to understand the importance of clean data from the LOS. So his theory was to grab the CEO, sit him down in a room and show him how quickly 1,000 loans could be loaded. And he did. And the CEO was like, oh my goodness, fantastic. Completely justifies why we bought this decision, because they were hand keying everything before. And the controller went, oh, wait a second. I just spent 4 hours cleaning up that data, right? So I'm 4 hours cleaning that data up so I could show you that. And I immediately changed the mindset of the CEO, because he was all about before not upsetting the loan officers, because it's the loan officers and the processors that are the ones that create, often cause the problem. And he was so upset with offending them and causing problems with them that he didn't, he didn't understand it. Once he saw it and saw actually these things are not nearly all that hard to fix and it really doesn't change that much of their life, it completely changed, because it meant that the business could justify the bill they paid for our software, and also allow accounting to do a lot more because they weren't hand keying all day. So that, I think, talks about the importance, but to kind of set the scene for you, Susan, I hope.
Okay, thank you. And it's funny because we hear that all the time. That is the number one issue we hear on a consistent basis, is that the information I'm getting from my LOS just isn't working right. And one of the things that we really strive to do is not only is to assist the accounting department in order to teach the people that are using the LOS system to grab the information correctly. And it's just it's a learning thing that every accounting department has to do. Everyone on this call everyone on this call has had that issues before, that the purchase advices weren't entered correctly, or their 2015 itemization, things are in the wrong spot, doesn't make sense, they're forgetting things, and so on and so forth. And what people don't, and this is kind of going back to what we talked about, the month-end close, and that we have to build that bridge. You got to build that bridge with that staff that's in the LOS system, and say, hey, listen, everything you guys put in here, it's what's going to drive our financials. And if we can't get that correct information, then our financials are just not going to look great. So this, like I said, everyone on this call has that same issue. It's something that's just,
I think even some of the most sophisticated accounting departments that we work with, and it's interesting because you'll say, hey, Casey, why are you still doing that way? And the answer is because it's what we've always done, and change is not for the faint of heart, that's for sure. But once you get there, and the lift that's provided is huge. So sorry, I interrupted you, Dustin. Go for it.
No, and I was gonna say, coming at it again from another perspective, and outside, looking in perspective, is when we start pulling stuff and getting stuff, you can always tell the clients that don't have good, clean data, because you pull reconciliations and there's, $100 reconciling items that they just don't know, unexplained, or $1,000. And a lot of that ends up being immaterial, but like at the end of the day, it kind of like, it raises a flag in our head that, hey, these it's not clean. We need to figure out, what's going on here. And a lot of it does trickle down into the end data. You just have a lot of little things that are adding up. That just, yeah. So
there's a reason why we see people that close the quickest, who have the cleanest data, have the best relationships with the rest of their business, and they have the best controls up front. Because at the end of the day, accounting is the end of the line, right? So whatever comes before that has to be controlled and managed properly for accounting to be able to do what they do. And frankly, business executives don't always like hearing it, Susan. I mean, you probably know, you speak to a lot more CEOs than I do. I tend to be in the accounting weeds with the CFOs and the controllers, but I'm sure it's an unpleasant conversation for you to sit there and say, well, the reason your accounting is struggling is because of all these reasons. Right. And it sounds like you're making an excuse, but as long as you can back that up, just like my example, right? Show them. This is the result of what happens when we have good, clean information. It changes a mindset, and rather than just throwing your hands up and go, well, they're never going to change it, right? Having those conversations and building those relationships, like you said earlier, with the other part of the business. Yes, there are tools out there that can help, and we are one of them, and there's many, many others, as I've already mentioned, and not just accounting tools, but expense management, invoice tools, and there's other things out there that can help streamline this stuff to help with the efficiencies and the automation. But a lot of it is so predicated on that LOS. And if it's a Wild West in the LOS, it's going to be a Wild West in Loan Vision, or whatever system you're using.
Right. Yep. We do have a question, and it's for you, Carl. They say, question for Carl: what is the average setup timeline to transition to Loan Vision and the setup cost on top of the software fees?
Sure. I mean,
it's huge bills from software suppliers when handling the setup. Thanks.
Sure. It's a bit of a difficult question to answer on a call without knowing a lot more information. Also, this isn't a sales pitch for my system, right? As I said, I'm on the call because I've been doing this for 8 years, but there are other tools out there that are great, and but I probably better off taking that one offline, because it's just so many variables, right? Depends on the number of loans you're doing a month. Depends on what modules you're looking for. A short answer to the time frame: it's not as long as you think. It could be 60 to 120 days, depending on the version of the system you go for. And cost wise, if you're used to buying non-industry tools and then customizing, absolutely, you're going to see some pretty huge bills. And I mentioned a couple of names earlier in more generic softwares where they don't really have the understanding of mortgage accounting. So, but with something like ourselves or A&B as well, I mean, we'll talk about both of us. Either one of us is going to be a lot more economical price-wise. I'm not going to say cheaper, economical, because we have out-the-box tooling. So we've built that stuff. We understand the industry. So we're not customizing a system, we're configuring. And there's a big, big difference in cost to that. So it's probably not going to be as expensive as you think as well. So I'm sure the team here are going to share information. So whoever those questions come from, reach out to me. I'll happily kind of give you the no strings attached answer to that. And if you want to explore it further, great. But the cost question's a little difficult to answer. But hopefully I answered the other two questions adequately.
Carl, real quick follow-up, because I mean, I know I get this question a lot. Is there a good time to make a transition and timing? Like, is it month end? Is it year end? Is it quarter end?
Right now, no. No, there's never, I've had that conversation over the 8 years or so that we've been in this space, and I'll be honest, their answer is no, right? And we've tried to have people be strategic. Well, if I start implementation in March, I can be done by June while we get really busy. Well, okay, maybe that school of thought worked for a little while till last year when everyone went nuts in April, right? So there's never a good time. If the business needs to do it, and if the business can identify the reasons for doing it and produce a proper requirements document and a proper kind of a desired outcome document, then you just got to get it done, because there's never a good time. You know, there's something going on all the time. Audit, month end closing, quarterly financials, busy season, Christmas, and everyone's off. We can come up with excuses all day. Just rip that Band-Aid off.
Yep.
Susan?
That's what I say, right?
That, or?
Rip that Band-Aid right off. There's never a good time. I mean, but everything is a good time, right? Because we hear that all the time. Oh, yeah. I'm so busy.
I should say that the other way around. Yeah, it's always a good time.
It's always a good time. Just do it. Yeah.
Yep.
And when you do make the decision to do it, I think the buy-in is huge, and making sure that everybody is fully, on the same page is a big deal with any software implementation, right? With any kind of change.
Yeah. The biggest problem, to your point, Casey, the biggest mistake we see people making is not coming with a clear idea of what they're trying to achieve, right? And subsequently getting the buy-in for that. Again, right back to the conversation start of the call. What is loan level accounting? Well, I need it. Yeah, but you don't even know what it is, right? So let's talk about what you're trying to achieve, and let's identify the problems you're trying to solve. Otherwise, you're just throwing money away. Okay, we don't. At the start of our engagement, the first thing we do is we don't do a demo. We do an introduction call, and on that call, we talk about what are you challenged with today and where are you trying to get to, so that we can start to clearly map that out. And if there's no clear definition of that, then probably it's not worth us talking at this time. If you want to continue to work on that, we'll help you define it. But we don't want to see people just throw money away just because they want a shiny gadget, which is a real problem in this industry, let's be fair, when actually maybe it's not the technology's fault. As I already said at the start of the call, and Susan, we've had some cases where people have changed software. It wasn't the software's fault. It was the process around it, and it was the business lead. So they've moved softwares and they've not achieved what they wanted to achieve. And it's so, well, you really need to understand what the challenge is. I'm doing a really good job of talking people out of buying software here, but
no, you make a really good point, because we hear that all the time. The process is just not there. So
yeah,
like I said, we've heard this all the time. The process has to be there, and if the process happens, then that makes the implementation or the moving to a different software work so much easier.
I mean, Susan, how many times have you heard? Because I know it's been probably 50 times in my 15 years in the industry. Like somebody, you bring it up to somebody, they're like, "Oh yeah, we bought the software; it's just sitting on our shelf," or "We bought whatever, we just haven't implemented it," or I mean, I think to that point.
And that's because the process is not there, and so they think they're broken. So therefore, the software doesn't work but it's not really the software; it's their processes. Yeah. So we hear that a lot.
I'd certainly say that is a common example. I mean, sometimes it's also people, right? The people just aren't qualified or don't have the knowledge. That's where you guys come in, especially, or you guys, or again another expert, but. It's a combination of those things. Those two are the biggest reasons,
Agree.
Well, having people in the right place too. I mean, it's sometimes it's tough as a business owner. You have legacy folks that walk your dog and house sit for you when you're out of town, and you really genuinely care about them, but they're not open to change. And there's one thing we know about this industry: we all need to be readily available and open to evolving and changing with the changing circumstances of mortgage banking. And I think that's a good time for us to segue into talking about right sizing your accounting departments, making sure that your internal and external spend is there. We kind of have all touched on 2020 and sort of the unprecedented situations that occurred, and having a plan B and making sure that you have support and you're not doing everything in a complete reactionary mode. I'd like to have Dustin kind of talk to the different roles within your accounting department. What is the CFO doing versus the controller versus a bookkeeper, and making sure that those are in line so you can stay efficient.
Yeah, no, for sure. I mean, I'll tell you, and Susan, chime in here where you can. I probably have a couple questions for you, but I'll tell you, I mean, again, 15 years of doing this, I don't think I've ever had somebody come to us and say, "Hey, we're overstaffed. What do we do with these people?" or something like that. I mean, now, granted, the people, that probably are at least right staff, they probably aren't coming to us with issues and questions, but, I think there's always that need. And a lot of times you get in there, you'll be meeting with a client or a prospect, and they're like, "Oh man, we really need a CFO." And so you start to talk to them, and you're like, "Well, what do you need?" and they start to explain it, and it's like, oh, we need somebody, to review all the reconciliations and, look at final financials and review the analytics. And then you start to just like take a step back. And you're like, well, that's not really a CFO's job. I mean, that's a controller's job. I mean, so we talk about a lot internally is having, the right people in the right seats or right places or whatever. And if you have, a CFO that's, still making journal entries or reconciling, or, I mean, even doing more than a basic review of financials and asking questions, your CFO is in the wrong spot. I mean, I'll tell you that starting at the highest level, that they should be there. They should be focused on strategy. They should be focused on, secondary sometimes falls under them. Like, so they need to be focused on the big picture, the strategy, where we're going, planning, that type of stuff. And maybe your company doesn't need a CFO. Maybe maybe the COO handles that stuff, and you just need a really good controller that can get, financials in. And again, just going down the path a little bit. I mean, if you have controllers that are, entering entries in every single day and getting stuff prepped and getting all the reconciliations and all that, then you probably have them in the wrong spot. Or or if you're asking a controller to do strategy work, why they're doing all that, then I mean, it's all about knowing, kind of the right, the right person for the right job, and knowing, when you've outgrown them and what you're really looking for. Susan and Carl, you can chime in too if you have any, one thing I've always struggled with is people will, an accounting department will come to us and it's like, hey, we need more people. How do we justify that? I mean, the accounting's, for the lack of a better word, a cost center. So they're like, how do we justify that? I mean, what, like, Susan, like in your experience as, CFO and stuff, well, I mean, what has been your justification? I mean, help, like, just.
Well, I think that you make a good point, because everyone looks at it as a cost center, right? And they're like, but what I think a lot of companies don't understand is that if you're understaffed in your accounting department, your financials aren't going to be correct, right? But we hear all the time, well, how many people do we need in our accounting department? Well, that kind of depends on a couple different things. Are you automated? What your process is, what's your month-end close look like, things like that. So it's super hard to say, oh, when you reach this, volume, you need X amount of people in your accounting department. I know, Carl, you and I talk about this all the time, because you have a company who's grown, triple, and they still have the same people in their accounting department. So yeah,
the challenge you face in the accounting team, and everyone that knows me on this call has heard me say this, or Martin Kerr say this once, right? Accounting is the red-headed stepchild of mortgage, right? And I can say that because I've got red hair and I used to be a stepchild. It's okay.
It's the red-headed stepchild, but it's funny because everybody's always looking for somebody with mortgage accounting experience too,
right?
At the same time.
It's the red-headed stepchild unicorn.
But the problem is, my point is that it's really it used to be, thankfully it's changing, but it was a necessary evil, right? Or an unpleasant necessity, I guess would be a better phrase. A lot of the guys that, folks that have started mortgage companies, they're originators, okay? So they don't really understand it, or they think they do, but they really don't. They took 6 weeks of accounting 101 15 years ago when they went to college, and they think they can account, right? That's the challenge you're faced with in those departments. So you've got to look at, technology versus people. Okay, what's going to be more cost effective? Is depending on where you live in the country. An accountant could be anywhere from 60 grand to 100 plus grand. Once you throw in benefits and things like that. Well, can I get a software for that and automate and remove that need? That get the cost of replacing someone when they leave. You should be looking at all of these things, right? Because yes, a tool is going to be expensive typically one time, right? If you buy it, or if you subscribe to a monthly, you can spread that cost out. But you really evaluate that cost against a person, and continuously having to rehire that people over and over again, or replace that person, it becomes much more expensive to hire, to continuously hire. But to your point, absolutely, there are a lot of very successful organizations running that have the right processes and controls in place that in this pandemic with triple volume haven't added a single person to their accounting team. That's because they have the right not just tools, but processes and people in place, and they've they've not added anyone. They've simply scaled on the technology they're using. So it's such a massive number of different factors, like you said, Susan, that go into, well, how many people do I need? Somebody quoted a number to me the other day, or is it 1 per 100 loans? Well, depends. Are you doing 100 wholesale, or are you doing 100 retail, right? Because that's going to be a lot more paperwork with 100 retail and 100 wholesale, and a lot more AP and things like that.
I'm hoping we can get a cameo appearance from Mark, because Mark Wilson always has some really interesting color to share here. And so despite his best efforts to stay off camera and out of the webinar, I think it's a good opportunity for you to kind of share your insight here, Mark.
Yeah, first of all, can you hear me, or am I still on mute?
No,
you can
you're
still,
not on mute.
Okay. I always challenge this idea that the accounting department is a cost center. Obviously, there's a cost to it, but I think the accounting department holds the answers to making profitable decisions. So if you're not investing in your accounting department, properly, then you're probably you might not be getting the answers that you really need to to anticipate a market shift. For example, as I think 2020 is a good example of how volumes go crazy. But if we look back to 2018, where we had incredible margin compression and some other things going on, if the accounting departments that we saw that were able to report that and get back to management in a quick manner, because the data coming out of accounting was good and solid. That was the difference in some of the years for our people in 2018 versus 2020, where a lot of people feel really good because volumes are up, but we're also going through a little bit of a market shift right now. So are you getting the information out of your accounting department? Are you just trying to get by? Are you just bringing in the least amount of people that you can bring in your accounting department? Things, you're trying to push the least amount of investment in accounting. And I think in the long run, the sophisticated companies survive because they know that accounting is important to invest in. If you're, it doesn't work. If you're a small kind of broker to banker and you're just trying to figure things out, I understand that it's hard to spend that money on non-production people, but there's a right balance to that, and as you evolve into a company, I think investing in accounting isn't necessarily a cost center, as opposed to it holds the answers to be profitable. Is the short answer on that.
Mark, you're absolutely right. I mean, Martin, our president, he comes from a background of manufacturing, right? And we talk about a lot of people talk about mortgage banking being a manufacturing process, okay? Mm-hmm. And he was staggered with just the lack of kind of priority that accounting or finance was given. They really didn't have a seat at the table. Thankfully, that is changing. But a lot of companies, that redheaded comment comes from a place of experience. Such an important department that holds the answer to how much money we're making and can we be more profitable and can we survive in a bad time is so often ignored. It baffled him, and he tells a story all the time of when things start to get tough, he gets phone calls from CEOs and CFOs saying, "Oh, can Loan Vision tell me this?" And it's things that people should always be looking at, even in good times. And his answer is, "It's always been able to tell you that. You just never chosen to look because you're cash rich right now." And that's a mindset piece, like you said.
Yeah, it takes you back to the loan level accounting discussion a little bit, where we sometimes talk about, in a lot of independent mortgage bankers, the tail kind of wags the dog, right? The dog being the company and the loan officer being the tail. And the problem with that sometimes is that, you might have a loan officer who wants to invest heavily in like a bond program or something where the margins are very thin. But if you had loan level accounting, you'd say, we should be pushing all our resources to government loans or whatever you might be better suited for. I acknowledge really the independent mortgage banker, especially in a retail operation, their customers is often the loan officer, really, right? So the company is structured in a way to make the loan officers happy, which is really important. But to do that with good data is invaluable, and you can't. I mean, you just can't. I can't stress that enough.
Yeah, I wanted to go back real quick on one thing on when you were talking, Carl, about technology and scaling with that. Another trend we obviously are seeing, and it's no plug because there's a few groups that do this, is outsourcing some of this. And we're talking outsourcing, not offshoring. There's a difference. I mean, this is a trend just in the accounting world in general. It's not just the mortgage space. I mean, the fastest growing departments of accounting firms are accounting services groups, and so. I think the mortgage industry is finally catching up to that and realizing, hey, we outsource all this other stuff. Why can't we, bring in an outsourced accounting manager to help with the, the day to day and that kind of stuff. I mean, there's certain tasks, and Susan can probably chime in a little bit on the certain tasks that an outsource isn't good at doing. But there's a lot of tasks you can outsource, and then to Carl's point, you can fluctuate with that. You don't pay benefits, you don't pay fully burdened cost. I mean, you pay a contract fee, and that's what you pay. And so it's it's a nice way that we're seeing a lot of clients starting to use that, whether it's us or somebody else in the industry. So yeah, I mean, I don't know, Susan, if you wanted to chime in a little bit on that, what we
I'll just say that an accounting, talking, this is going to sound strange coming from an accounting someone that sells accounting software, but an accounting software isn't going to solve all your problems on its own, right? It's going to go a long way, but if you've got the wrong people running it and the wrong controls, and we talked about all these things earlier, it's only part of the problem. And we are absolutely seeing more and more people considering outsourced accounting services, whether that's to help out with AP or with purchase advices. And we're definitely seeing more and more of it. And I think that will continue to happen as the market fluctuates, because it's easier to manage. We're definitely seeing more of it.
It's scalable.
Yep.
Right. Yeah.
Yeah, I mean, obviously, like Susan said earlier, your accounting department needs are a constant state of change, and you'll go through a period of strategic focus, and then you'll go through a period of catch up, and then you go through a period of quality, and then and those you'll get through that particular period and need to move back to a different one. And I think continuity of service, continuity of staff, continuity of ability to scale up and down where appropriate. It's a tool in the toolbox, certainly that we're certainly seeing a big pickup in that part of our practice. Not
exactly.
Yep. Well, I think, Susan, you can piggyback on this a little bit. I mean, I think that even with automation and even with the outsourcing and again, not offshore, but the outsourcing piece, I think we still find that it's critical to have at least, a key member, if not a few key members internally that are still there in the day-to-day that can run your internal accounting and be the bridge to the vendor, right? Or be the bridge to the extension of your accounting department. So I think that even with automation and it's still important to have the right people in place to kind of have that internal voice. I mean, what do you think on that, Susan?
I absolutely, agree. I mean, there's certain tasks that work better with someone who's part of the company who can run point on between their operations, but outsourcing is a great tool. I mean, especially because in this market, Mark just made a really good point, when you're trying to pivot super fast, and it's so hard to find, people that are specialized in the industry. And we all know this isn't, a specialized industry as far as accounting. It's hard to find that. And then there's a huge learning curve on that, right? So, when you outsource, the person steps right in. There's no learning curve. There's no training period. The person knows what they need to do. They understand the language, the lingo, and all that other stuff. So I think we're finding we can help people that way a lot faster than trying to find someone to kind of fit in a shoe that just.
Yeah. It's all about
there,
the
so.
size as well, isn't it, Susan? You know, it is is outsourcing alone the only the answer on its own? Of course, it's not.
No.
You know, if you're a smaller lender, you might be able to get away with outsourcing a lot of it. Maybe you keep AP in house, or as you grow, maybe you do need a strong controller, and the outsourcing does a lot of the legwork and maybe some of the more strategic stuff. And then once you reach that size, maybe you've got a CFO and controller and some strong accountants, but you need some help with the, I don't want to say grunt work, but that, you know, it depends on,
Right.
you know, the
Absolutely.
size of the company, and
Exactly.
you know, these things in unison work well together. One is not necessarily the answer alone, is it?
Right. Exactly.
Okay. Does anybody? I don't see any other questions on here. We're approaching kind of time. Does anybody else have any questions or things they want to add on here? Nope.
No.
I will take the silence as a no. Okay. Well, if anybody has, you know, I think that as we end here, that it's an interesting topic of conversation, and one that's brought to us often is what's the right mix of internal versus external spend? You know, is automation worth it? I encourage all of you to reach out to Susan, myself, Dustin, Carl. Let us know. I mean, we love to have these conversations, even if it doesn't result in some kind of a partnership. We're invested in this industry, and you know, whether or not. Go ahead.
That's a really great point, Susan. I wanted to say a couple of Susan, Casey, even close.
Okay.
I mean, we've been around 8 years and we've seen a lot of things, and you know, I know you guys are always happy to talk to someone if you're mulling things over. There's every chance we or another software might not be the right choice, right? It may be better that, and we're always going to push people down that road. We're never going to try and force our technology on somebody if it's not a right fit. So that's a really, really great point. If you do have questions, reach out. There's no strings attached. You're not going to get a hard sell or anything like that from any of us. I mean, that's why, you know, we enjoy working with you guys, because of that kind of, you know, that long-term partnership piece there. I will also say thank you guys for including me on the call here today. I have no idea why you did, but it's probably because I can sound impressive, even though I know nothing what I'm talking about. But thank you so much for having me. It's always a pleasure to do this kind of thing. So,
of course, thanks for taking time out, Carl. We appreciate it. And any of you that have ideas for future webinars, we definitely want to stay in front of what's top of mind for our industry professionals. So feel free to reach out and let us know, and stay tuned for our next webinar on servicing and MSRs. And Carl's going to actually run that one too, because that's obviously his area of expertise. So,
yep. MSRs. Trying to think of something witty.
I think we need to get Carl on a dad joke webinar, which I saw some stuff going around LinkedIn where he did a pretty good dad joke.
I'll join the dad joke one for sure. Hey, I do want to invite everybody though who's on the webinar to make sure if you have questions or if you have something you didn't want to ask live, please send it to us separately. And we want to know what you're struggling with too. Any bottlenecks in your department or other things. We're always trying to do better and build our services around that. So let us know. We're here to support you, and that's why we're doing these webinars. So.
Yep.
Right. Perfect. All right. Thank you, everybody. Thank you so much for your time.
Thank
you, everybody.
Thank you.
Okay, bye-bye.